3 weeks ago, I launched an exciting small account challenge using the Moomoo trading platform to test 6 brand new covered call ETFs with $1,000. And if you missed that video, I'll pin it at the top of the comments so you can see how this all started. And I use the Moomoo platform for ease of use. The ETF screening tools and real-time data help me stay on top of these new funds, and their AI insights are actually pretty useful for understanding dividend patterns. And they're actually providing a limited time offer to all my viewers right now. You'll get up to $2,000 in commission-free rewards, a 6% APY cash boost, $300 deposit rebate, and $2,300 transfer rebate. That's a $4,000 in total value to kickstart your investing journey. So the link's in the description if you want to check it out. But let's get into why I'm making some major changes to this experimental portfolio after 3 weeks of tracking. I'm narrowing down the competition to just 2 contenders and eliminating 4 ETFs from this challenge entirely. And here's the thing. The decision didn't come down to performance data at all. So let me start with saying I'm keeping QDAY and SDAY moving forward. Honestly, these ETFs are just so new that there's not enough performance data to make any real judgment calls about their long-term viability. QDAY launched as part of Hamilton's new Daymax series, and we're still in the early stages of how their zero DTE option strategy performs in different market conditions. But here's what sold me on both of these: bi-weekly dividend payments. Instead of waiting for a full month for distributions like traditional covered call ETFs, I'm getting cash flow every 2 weeks. And this isn't just about getting money faster, it's about creating more opportunities to reinvest those dividends and potentially more educational content for this channel. Think about it. With monthly dividends, I get 12 opportunities per year to show you what I'm buying with that cash flow. But with bi-weekly payments, that doubles to 24 opportunities. Well, maybe 26 opportunities per the comments I keep getting, so double check that one. Either way, the more frequent dividend payments means more frequent buying decisions, which translates into more educational content about portfolio building and dividend reinvestment strategies. And yes, I know QDAY creates overlap with my existing HHIES position since both focus on technology, but I don't mind that overlap because the bi-weekly payment schedule is something completely different from what I currently have. And it's worth testing this payment frequency, even if it means some sector duplication in my portfolio. Now let's talk about why I'm eliminating the single stock ETFs, NVHE, PLTE, TSLY, and MSTY. And again, this isn't about performance because frankly, there hasn't been enough time to evaluate their true performance. This came down to a personal realization. I just don't like betting everything on one company. Whether it's NVIDIA, Palantir, or Tesla, putting serious money behind a single stock, even wrapped in a covered call ETF, feels too much like gambling to me. These 3 weeks showed me that I'm just not comfortable with that level of concentration risk, regardless of how good the underlying companies might be. Now, some of you might point out that MSTE, which I already own, is pretty close to the single stock exposure since it's just a leveraged version of MSTY. And you're right, but I wouldn't have decided to get rid of MSTY if I didn't already own MSTE. Currently, I am holding more MSTE than I would like, but I only justify that because it's more like investing in Bitcoin and crypto in general, not on one company's specific ability to execute. Or at least that's how I perceive it. It's still risky, but it's betting on an asset class rather than corporate management. So I don't have issues with MSTY conceptually. I just own too much MSTE right now to justify holding it. And I think the single stock covered call ETFs just don't sit well with me personally because these are all normally stocks that I would buy on dips and sell on the bounce back. It's not my preferred investing strategy with these specific companies. So here's my plan moving forward. I'm selling all positions in NVHE, PLTY, TSLY, and MSTY once I receive my first round of dividend payments from each. I want to collect at least one distribution to see how their payout process works, but after that, they're gone. The proceeds from these 4 positions will be split evenly between QDAY and SDAY, not because they've proven themselves through performance, we just don't have enough data for that yet, but because I like the bi-weekly payment structure and the content opportunities it creates. I'm just being honest. More videos for you guys. And by the way, I've been using Moomoo as a quick and easy way to research these ETFs. Essentially, I have everything I need in one place, like simply checking the monthly dividend history. So that's just another cool thing about Moomoo. So this experiment has taught me something important about my own investing psychology. Performance data is crucial for long-term decisions, but sometimes you need to trust your gut about what feels right for your personal strategy and risk tolerance. I like the idea of bi-weekly payments from QDAY and SDAY because they align with my goal of creating more educational content around dividend reinvestment. More frequent payments mean more frequent buying opportunities, which means more chances to show you real-time portfolio building decisions. So that's why I'm doing it. And I realized I don't like single stock covered call ETFs because I prefer using a different investing strategy when working with single stocks. So moving forward, I'll continue tracking QDAY and SDAY, but I'm being completely transparent here. This decision was based on payment frequency and personal comfort level, not performance metrics. Sometimes the best investment insights come from understanding your own preferences, not just analyzing numbers. And next week, I'll be showing you exactly how I'm using Moomoo's platform to execute these position changes and reinvest the proceeds between QDAY and SDAY. And we'll also dive deeper into why bi-weekly payments might be a game changer for dividend-focused portfolios in 2025 and 2026. So if you want to start your own investing journey or follow along with a challenge like this, remember that Moomoo is offering that incredible welcome package I mentioned earlier. It has that $2,000 in commission-free rewards, 6% APY cash boost, $300 deposit rebate, and $2,300 transfer rebate when you sign up through the link in my description and first pinned comment. All right, leave a comment below. Do you think I'm making the right call focusing on payment frequency over performance data at this stage? And remember, my decision-making process just goes to show that sometimes the most important investment decisions aren't based purely on numbers. They're about understanding what strategy fits your specific goals and personality. That's why you should never copy exactly what I'm doing. I have way too many other factors outside of just immediate income that affect my decision-making. All right. Now watch these two previous videos from this series in case you missed them. Bye, guys.